Back in March of 2025, I called ASML one of the most undervalued companies in Europe. Since then, the stock has climbed more than 140%. And today, it's trading close to the richest valuation it's carried in over a decade. So naturally, the next question is, where's the better opportunity today? Is it still ASML, or has the opportunity shifted to TSMC, the manufacturer of nearly every advanced chip in the world? Today we're putting both through my 5 key factor framework to declare a winner for every round. And make sure to watch until our valuation section, where a direct comparison between these two giants proves the market might be making a massive mistake. Let's start with the most important question. If AI demand keeps growing, which company is best positioned to defend its profits? Morningstar gives both companies a wide moat. That's rare. But the reasons couldn't be more different. Let's start with ASML. ASML is the only company on Earth that builds extreme ultraviolet or EUV lithography machines, the technology required to produce the world's most advanced semiconductor chips. Despite decades of trying and billions spent, no rival has ever caught up. Catching ASML isn't just a matter of capital, it requires decades of specialized engineering, an exclusive supplier network, and thousands of patents. Once a fab is built around ASML hardware, switching costs are astronomical. The moat doesn't end there. Each machine also generates decades of recurring service revenue. In fact, ASML expects the lifetime service revenue on its newest EUV systems to exceed the original selling price of the machine itself. Now let's look at TSMC. Unlike ASML, TSMC doesn't have a monopoly, its moat comes from execution. Mass-producing leading-edge chips is brutally difficult. Fractions of a percent in yield optimization mean billions in savings. Which is why giants like Apple, NVIDIA and AMD refuse to leave TSMC. Years of manufacturing expertise, enormous scale and industry-leading process technology have made TSMC incredibly difficult to replicate. Both companies possess extraordinary competitive advantages. But only one controls a critical bottleneck for the entire semiconductor industry, and that's ASML. Every chart and every financial metric in this video comes from Fiscal AI. It's the platform I use for every stock analysis on this channel. Link in the description for 15% off. A moat is just a theory, until the returns back it up. Let's start with TSMC. TSMC's return on invested capital has steadily climbed to an exceptional 39.5%. ASML sits at 40.6%, financially they're virtually identical. Return on equity tells a slightly different story. TSMC generates an excellent 35% return on equity, ASML comes in higher at 43.3%. But there's an important reason. ASML repurchased roughly $7 billion worth of shares in 2025. Those buybacks reduce shareholders' equity, mechanically boosting return on equity. Since TSMC doesn't operate a similar buyback program, the underlying profitability of these two businesses is actually remarkably close. Great businesses grow, exceptional businesses grow for decades. Let's compare both companies side by side. Revenue first. Over the past decade, TSMC has compounded revenue at roughly 17% annually. Net income has grown around 20% annually for TSMC. Now looking at ASML, revenue growth comes in higher at just over 20% per year. The same applies to net income at almost 24%. And finally, earnings per share. TSMC has compounded earnings per share at roughly 20% annually, while ASML has delivered more than 26% per year. ASML's earnings per share has grown faster than net income due to the share repurchase program. So looking back, ASML has consistently outgrown TSMC across every major growth metric. Analysts expect TSMC to grow net income by roughly 38% annually through 2028. ASML is expected to grow slightly slower at around 34% per year. Round 3 is a tie, as the growth numbers are highly comparable. Great businesses earn profits. Exceptional businesses turn those profits into cash. Both show outstanding long-term free cash flow growth, TSMC compounding at 19.3% annually and ASML leading at 25.6% thanks to its highly asset-light business model. Beyond the cash flow, both companies boast absolute fortress balance sheets. TSMC holds nearly $100 billion in cash against $33.9 billion in debt, while ASML holds $15.7 billion in cash versus just $5.2 billion in debt. Incredibly, both giants could erase their entire debt load with just a single year of free cash flow. Now we arrive at the question that probably made you click. Which stock offers the better opportunity today? Let's start with TSMC. TSMC trades at roughly 22.5 times forward earnings. That's above its historical median, but still comfortably below the highest valuation investors have been willing to pay over the last decade. Now let's look at ASML. ASML trades at almost 45 times forward earnings. That's close to the richest multiple it's carried in more than 10 years. Back in March 2025, ASML was trading well below its median and I called it undervalued. Today I don't think that's true anymore, but valuation alone never tells the full story. That's why I always look at the price to earnings growth ratio, which adjusts valuation for expected long-term earnings growth. TSMC trades at a PEG ratio of roughly 0.8. ASML almost exactly 2. That's a huge gap. So why is TSMC so much cheaper? Part of the answer is geopolitical risk. Most of TSMC's advanced manufacturing capacity still sits in Taiwan. Investors have demanded a discount because of that uncertainty for years. But the picture is gradually changing. TSMC is investing heavily in manufacturing capacity across the United States, Japan and Europe. It has committed $265 billion cumulatively to US manufacturing in Arizona. But Arizona won't eliminate geopolitical risk. US manufacturing is significantly more expensive and the most advanced nodes still remain in Taiwan. Arizona mitigates the risk, it doesn't erase it. That's exactly why the market demands a steep valuation discount on TSMC compared to ASML. Now let's put the scoreboard together across our 5 key factors. ASML wins the economic moat. For returns on capital, growth and financial strength, it's a tie, and TSMC wins on valuation. ASML is one of the highest quality monopolies I've ever analyzed, and its role in AI is undeniable. But after a 140% rally, the market already knows it. Today you're paying nearly double the earnings multiple for ASML compared to TSMC. Meanwhile, TSMC dominates advanced chip manufacturing, matching ASML's elite returns on capital with a fortress balance sheet to back it up. And still trades at a valuation that in my opinion more than compensates investors for the geopolitical risks. Sometimes the best business isn't the best investment, and that's exactly what this comparison taught me. If I had to choose one stock today, it would be TSMC. Now I'd love to hear your opinion. If you could only own one for the next decade, would you choose ASML or TSMC? Let me know in the comments below. I read and reply to every single one. And if you found this breakdown valuable, don't forget to hit that like button and subscribe so you never miss out on future deep dives.